So starting really basic, but basically like a stock, if you own a stock, that means you own a tiny piece of ownership of a company. So like if you own a stock in Apple, you own a very small percentage of the Apple company. And when that company does well, then you make money. And if they do poorly, then you lose money. And I always say, like, so if you look back 30 years ago, and 30 years ago you invested in Apple, today you're super happy because Apple made a ton of money, your stock went up a ton, you made a ton of money. But if you invested 30 years ago in Enron, today you're really upset because that means you lost all your money. And it's really easy now to look back and go like, well, what moron is investing in Enron, you know? But if you look back, you can find like newspaper articles, online articles, whatever, of experts and pundits saying like Enron's a can't miss and Apple's a can't miss. And that, in a nutshell, is kind of what individual stock picking is. You know, you're betting, just like you're betting on a horse, you're betting on a company. So in that sense, investing can be really risky. But what's a much more safer way to invest is if you look at the overall stock market. So if you like on your iPhone or Android, there's usually a pre-downloaded stock app. So you can pull that up and look at the overall stock market. And if you look at like a short time period, like a day or a week or a month, it'll kind of just look like an EKG going up and down with no pattern. What you do is you just start zooming out and you start going back to a year timeline, 2 years, 5 years, 10 years, 20 years, all time. And what you notice is that EKG starts becoming just a steady trending line upward. And so the overall stock market has over the long term has always been a good investment.